Hi there, I'm Mark Insley of Ascot Wealth Management. We're here today to take you through a very interesting topic that was recently presented on at one of our seminars in both Fox Hills in Berkshire and our True Potential offices in central London, where we had many attendees informed on these very important topics of ours. All these videos are going to be available on our YouTube channel, so please tune in both for this session as well as many others we have recorded for both education for clients and potential clients. Today's session is going to be on the retirement planning when your annual allowance has been impacted or fully used in what would have been your usual more traditional pension planning. The session will focus on reviewing the annual allowance and the changes that have occurred over the last few years and how they're impacting clients. We'll briefly talk about other allowances in this space, such as the lifetime allowance and what that may mean for you and your planning. We'll then move on to a brief review of what may be deemed alternatives to pension planning for those that have lost their annual allowance. These tend to be the Seed Enterprise Investment Scheme, Enterprise Investment Scheme and Venture Capital Trusts. So what is the annual allowance? The annual allowance is the maximum amount that an individual in both their own contributions as well as employer contributions can put into a UK regulated pension during any given tax year. The changes really have been quite dramatic. In the sort of late 2008-2009 period, there were absolutely no restrictions. So there generally was years when there was hundreds of thousands going into pensions and receiving the highest rate of tax relief. The initial reduction was that this was deemed too beneficial to those able to contribute salary into pensions and get this tax relief and build huge retirement pots. And so the government brought in an initial cap of £50,000 per annum for individuals contributing to pensions. This has now dropped to £40,000. Those changes came in the 14-15 tax year. And as well, please be careful of the 15-16 tax year, where there was a normalisation of the pension input period, and as a result, any pension contributions before the 8th of July 2015 were given its own annual allowance of £40,000, and any pension contributions after the 8th of July to the 5th of April 2016 receiving a second allowance. So for some lucky people, there was the opportunity to put £80,000 into a pension that year. And then, as we still stand now, an annual allowance of £40,000 that has been tapered from the 16-17 tax year down to potentially a maximum £10,000 per year for some individuals. So this tapering, as we said, came in the 16-17 tax year and really has been quite penal. And as well, to many not just defined contribution members, but actually those also in final salary or defined benefit schemes, where although not physically contributing, changes in salary and a deemed accrual above £40,000 has seen huge tax bills. So there's been some publicity of those with the NHS final salary schemes being very unaware of the tax bills that had been occurred on individuals just by them being members of these very generous schemes. So the tapering first comes in with a calculation done at £110,000, and that £110,000 has to include base salary, any commission, any overtime, bonuses, dividend payments, rental income, bank interest. Additionally added back in anyone that has salary sacrifice. The salary sacrifice amount that the individual was made needs to be added back in. And essentially the first test is, with all these sources included, are we above or below 110,000? If we're above 110,000, then all other employee contributions also have to be added on to that number that the individual has reached. So lots of people think this only starts at 150,000, but the first test is actually at 110,000. So if your annual allowance, your threshold income, as it's called, has gone over that 110,000, then you have to have an adjusted income number. If that adjusted income number is over 150,000, then you lose £1 of your annual allowance for every £2 that you're over. So essentially, anyone that has an adjusted income above 240,000 will essentially only have an annual allowance of 10,000 because they will have lost for that £2 over from 150, they will have lost that £30,000 of annual income. So it really is penal. The more you earn and more rental income and stuff you've got. But yes, there's lots of people that have both a tapering, because perhaps they're at 180,000 once that calculation has been done. And in that instance they'd lose 15,000 from their annual allowance, as well as others fortunate enough to have a salary and other income that takes them in excess of that 240, where they now are capped at 10,000. So we have seen lots of employers bring in schemes for those high earners, where an individual's pension is restricted to just an employer contribution of 10,000, and perhaps if they're fortunate enough to have employer contributions above that, that's usually now passed through salary. But hopefully that's a brief education into how you may or may not be affected by threshold income and adjusted income. So moving on to the lifetime allowance. So again, the lifetime allowance is in the pension space and has really seen drastic changes in the turn of the century. Again, in the early years of the century, very little restrictions before 2006. In 2006, we had A-Day with a whole new regime of pension allowances, and one of which was the lifetime allowance. So the lifetime allowance was moved to 1.8 million. In 2012-13 tax year, this was dropped to 1.5 million. More recently, in the 2014-15 tax year, it's dropped to 1.25 million. And then, to many people's surprise, in the 16-17 tax year, it's dropped all the way down to £1 million. So people could well have accumulated more in pension savings than that million. As these changes have been made, there have been protections offered by governments. So, if you had a calculation that was above 1.8 million when it dropped to 1.5, you were able to fix or have a locked-in lifetime allowance of 1.8 million. And likewise, the same sorts of schemes for individual and fixed protection have been offered to individuals. So perhaps you're still able to look at claiming one of those if you do think your pension was above these limits during those periods. Now the lifetime allowance is tied to the consumer price index. So there's an element of inflation linking, and from the million we've now moved back up to 1,055,000, and that will get adjusted every tax year that we go through. One other point to mention in this other allowances is the MPAA, and this is only relevant for those over 55. So what happens with the money purchase annual allowance is that anyone that goes into flexible drawdown and takes income, so there is a bit of a rule here where someone can take their tax-free cash and they're not deemed to have breached the MPAA rule, they will still retain an annual allowance of 40,000. So perhaps someone is still working, they've taken their tax-free cash, doesn't mean they've lost their annual allowance down from 40 to what is only an MPAA of just £4,000. But yes, once you go into flexible drawdown, that annual allowance drops to just £4,000 per year. This was brought in again as a government tax saving measure in the times of austerity, and to prevent those deemed wealthy pensioners still contributing whilst working, whilst drawing down onto their pension. So some liberalisation in the introduction of this, but yes, those in receipt of flexible drawdown will only have an annual allowance of £4,000 per year. So what options might there still be available to you? The first that we always look at for clients is the use of carry forward. So the use of carry forward is essentially utilising the prior 3 years tax annual allowances to see if a larger contribution could be made in the current tax year that would be above the 40,000, but would be able to use spare allowances from the earlier tax years. So you'll see in this example here an individual who's made varying contributions over the last few years, but the end result is that they have space from previous annual allowances to make that larger contribution. For those affected by the tax trap, let's say for an example that has a salary of 160,000, but a tapered annual allowance perhaps of only 20,000, that individual might still be able to make that £60,000 contribution that would receive a huge amount of tax relief, because that individual would have lost their personal allowance for £1 every £2 that they're over 100,000. So some of that 60,000 contribution would actually get tax relief of 60%. As well as the 40, a small bit of 45% relief on that tapering of salary. So yes, that individual could use the 20,000 of their current annual allowance, but perhaps have enough space in those previous 3 years to facilitate that other 40,000. So still is very much a pertinent tool. Being in the 1920 tax year now, this is the first year where all 3 years prior have been affected by the tapered annual allowance. So unfortunately, it has become a rather complex calculation where not only the current year, but each of the 3 previous years have to have that tapered annual allowance calculation done to work out the exact amount of space. So if you're someone that thinks you could benefit from that, hopefully come in and see us as professionals with the models and spreadsheets to get this calculation accurate, because what you don't want to do is over contribute and cause yourself a massive tax headache. So moving on to other alternatives outside of the pension space, because unfortunately, it's a fortunate position to be in, but for individuals that perhaps now can only make 10,000 because they've used all their carry forward, fortunate enough to have a large salary that means they can only perhaps have an employer put 10,000 in, they're now in a position where they actually put in no personal money towards their retirement. So this is perhaps where the enterprise investment schemes, the seed and EIS scheme come into play, or perhaps the venture capital trust scheme. So this session will just have a brief reminder, and one of our other tutorials will go into much more detail on how we think in particular venture capital trusts can be used as a pension saving vehicle. But yeah, as you can see on this slide here, just a brief update of the 30% tax relief that an enterprise investment scheme investment receives, the 50% tax relief investment into a smaller company the CDIS scheme receives, as well as the 30% tax relief that a venture capital trust investment makes. But they're deemed as suitable alternatives because, like a pension, on each contribution made, they're getting that immediate tax relief back from the government. So again, touching on the enterprise investment scheme, encouraging investment into startup businesses, many rules attached to this scheme, million maximum investment. The enterprise and the seed investment schemes have the unique opportunity that on a £10,000 investment, you may well have got your £3,000 initial investment, but as I say, very uniquely, if the company goes bust, the other 70% you haven't got tax relief can actually be offset against your income tax again. So for many, EIS investment only actually carries 36p risk in each pound invested. If the investment's held for 3 years, all capital gains are completely tax-free. The seed enterprise investment, similar to the EIS in that it's an investment into ordinary shares of a business raising capital. The difference here is that it's 50% initial tax relief. That's an added bonus because a company has to only be a small size, and there's restrictions around which companies qualify for seed enterprise investment scheme. And again, the maximum investment for an individual is only 100,000 versus the million for the seed enterprise investment scheme. And then finally, venture capital trusts. Venture capital trusts, where this is a government scheme where these are investments into much larger companies. The fund goes out and raises perhaps 10 or 20 million. It actually gets issued an ISIN and CDOL, so it becomes a regulated London Stock Exchange investment, and then the fund invests into much probably later stages than the enterprise investment scheme opportunities that are available. So perhaps an EIS, successful EIS, perhaps as a payout of perhaps up to 10%, but you've also got to be comfortable with the fact that perhaps 3 of your 10 investments are going to go bankrupt and be worth nothing. As I say, the venture capital trust scheme invests in much larger companies. However, you still get that initial 30% tax relief. You don't get the loss relief. Maximum investment is 200,000 rather than the 1 million of the EIS scheme. And actually, we think, as I say, I won't spoil it completely for my other presentations, but we think venture capital trusts perhaps the most suitable as a replacement for the pension saving and the annual allowance, which is the focus of this presentation, because there is actually the option with many funds to have your shares bought back off you after 5 years. So interestingly, you could get your 30% tax relief and certainly have an opportunity to have a return of capital in 5 years. That's not a guarantee. In addition, venture capital trusts quite uniquely pay completely tax-free dividends, and most venture capital trusts aim to pay about 5 to 6% dividend per year. So over that 5 years, you may have got your 30% tax relief, you could have got up to 25 to 30p back in tax-free dividends, as well as hopefully having the opportunity to sell your investment to either a private investor or perhaps back to the venture capital trust itself. So those certainly are three alternatives we're seeing clients interested in and certainly utilising in the current tax year as a replacement for pension saving for those affected by the annual allowance. So thank you very much for your attention in this presentation. Hopefully it's been useful and you'll be able to tune in to many of our other videos available. As you can see here, this is a link to our YouTube archive of the multiple videos that we've recorded both on the investment, tax and financial planning space. So thank you once again for your attention.